Judge has voided Elon Musk's $55 billion Tesla pay package.
The options arena can be complex to maneuver, and there are also pitfalls to avoid.
On average, it is speculation, and I think, unfortunately, some people treat it almost as gambling, and gamblers don't win most of the time.
If you get into options, number one, it requires a certain degree of focus and activity because options expire all the time.
All that and more. So let's get to it. Tesla stock is down in the pre-market almost 3%? What the happened?
Judge has voided Elon Musk's $55 billion Tesla pay package. We want to go now to Bloomberg Technology co-host Ed Ludlow in San Francisco. Ed, what else can you tell us?
Well, in the first instance, Tesla shares are down significantly in the aftermarket, more than 2%. What shareholders alleged in their suit is that Tesla's board and its directors did not act with impartiality when setting the $55 billion compensation, which is a historic record for any compensation package for a publicly traded CEO.
Yeah. Record package for record market cap growth, maybe? Many people believe that Tesla couldn't hit any of those milestones. Now we get to back out of the deal once he's hit his marks? Sounds like welching to me. And where I'm from, that's a good way to get your ass kicked.
Yeah. And the judge in this case, Kathleen St. Jude McCormick, is agreeing with that in the sense that investors had to go hunting to clarify whether or not there were conflicts of interest in the apportioning of that reward. And as you can see, the market paying attention when Musk took the stand to basically defend his position in that compensation. He said, well, I had nothing to do with it. I don't set my own pay. So how could there be any leverage that the board would put over me or me over the board, which is what the conflict of interest in question, the concern was about.
I'm sorry. The board put together a compensation package. Shareholders then voted on said package. Now, I wasn't a shareholder back then, so I don't really have a dog in this fight. But it seems to me that the board set such outlandish goals that no one thought that Elon Musk could meet, to the great benefit of shareholders at the time. Shareholders then voted on said package, but now when it comes time to pay the piper, you want to welch on the deal? And a judge thought this was okay? We'll get the out of here. I can't wait until the board finalizes the next compensation package for Elon Musk. Best believe your boy will be voting on that with his eyes wide open. As long as the milestones send Tesla to a multi-trillion-dollar company, a conflict of interest, pay that man his money. Now, the value of my options contracts has diminished greatly since the start of 2024. Yesterday, I placed 2 call options at the 195 strike price, set to expire at the end of the week and the end of next week. Well, the news of Elon Musk losing this compensation package has sent the stock tumbling. Definitely some ground to make up for the options contract that expires here at the end of the week. More than likely, the calls that I made yesterday will expire worthless. But due to Tesla's volatility, there's always a chance.
A new generation of retail traders is flocking to options trading as an alternative to plain vanilla stock investing. But the options arena can be complex to maneuver, and there are also pitfalls to avoid. So we're starting off with the basics in Yahoo Finance's Options Week 101. And let's start with a very simple definition here. This is a stock option definition: financial contract that grants the buyer the right, but not the obligation, to buy or sell a stock at a predetermined price within a specified period of time. Just tell some of the important aspects of this for us.
Well, it's important to remember, Jared, that it is a right, and that's where the word option comes from, as opposed to, let's say, a futures contract or actually buying the stock where you're obligated to own that underlying security. As a result, the price tends to be lower, but the very important parts are you have to get that target price correct because there's a predetermined price, and you have to get the time frame correct. So there's a lot of it's much less of an outlay, but you really have to get everything just right for it to work out for you.
Like the calls I placed yesterday, the timing was not so good. At the time of purchase, I expected the stock to go up, but in the after hours, yeah, the stock went down a couple of percent. Whenever you place a call or put, you want that stock to go in that immediate direction. Depending on the time of expiration, you have a little wiggle room, but know that THETA is always eating at your premium.
All right. right, with that, we have calls and we have puts. Calls are the right to buy a stock, put is the right to sell, but that's if you're long. If you're selling the stock, it's a little bit different matter. And for the newer investors, we're probably going to be thinking about buying calls or puts there, right?
Yeah, most people start off by buying options outright. There are a lot of people who do end up writing options, particularly covered calls. I know you'll get to that later.
We're going to get to that tomorrow,
yeah,
actually.
No, I'm not gonna front run the next guest.
About a week ago, I did just that. I sold a Tesla 230 call that expires on March 1st. Someone paid me $610 for the right to buy Tesla stock at $230 per share. At the moment, no one in their right mind would buy Tesla stock at $230 a share when it's currently sitting at $185 per share. They would just buy the 100 shares at $185. But should the stock soar above $230, I run the risk of having to sell 100 Tesla shares at $230 per share. Hypothetically, by March 1st, if Tesla stock is at $275, I still have to sell it at $230. In order to do this, however, you have to have 100 shares of the underlying stock that you're willing to part with should someone decide to exercise that call.
It's typical to think in terms of buying them to begin with. And, again, it's a fairly limited outlay compared to the price of the stock usually to either speculate about, whether it's going to go up over that period of time or whether it's going to go down depending on the contract.
Defined risk, a concept we're going to come back to. So the structure of a call option here, first of all, one option equals 100 shares, and then we have a couple different things. Maybe you can go through and outline the importance of each one of these things.
Yeah, so when you see the price of an option, you have to multiply that by 100. So if you see it trading at $1.50, your outlay is actually going to be $150 because it conveys the right to buy 100 shares. One contract buys 100 shares. The expiration date is predefined. So you're buying the March 190 calls on Apple.
Yeah,
so
there's
you have
weekly and monthly expirations there.
Even
daily.
dailies for certain ETFs and index options. But we'll stick here to the weeklies and the monthlies for common stocks. But you do specify your date when you buy it, and you specify your strike.
Right there.
So the expiration date and the strike, and when you go to look at the quote, that gives you the premium.
And that's what you're paying if you're buying it.
Exactly. So you pay that premium. It's especially if it's an out of the money option, meaning that if it's a call, the price is above the strike. The strike price is above the current price, or a put, the strike is below. That is pure premium. There is no intrinsic value to that option. It's just really what you're paying for the right to speculate on the stock price over that period of time.
So important to say that premium can just disappear 100%. That's something that you're just outlaying from the beginning there.
There's few guarantees in options land. One of them will be that there is no premium left on expiration date.
Yes.
It's either going to be in the money or it's going to be out of the money. And this chart shows you that. So
we have first of all, this is for an Apple 190 call. And this is a typical profit and loss chart. So get used to this. We're going to be showing a lot of these. And in this example, this is the 190 strike, and it's $3.50 per share. But maybe you can try to break down the structure of this.
So if you're paying $3.50, so this little red line means that if it closes below 190, you lose all $3.50. You have to get it up and above 190, $3.50 for you to even break even. On the other hand, though, the advantage, the appeal of options is you could see how fast that line accelerates.
Right.
So if you get above that 190, $3.50 hurdle, the strike price plus the premium paid, that can accelerate very quickly, and that's the appeal that keeps people trading in options.
Now, Tesla's volatility is a double-edged sword. Because it is so volatile, can move up or down 4 or 5% in a day. If you're buying calls and puts, the premium is going to be quite thick. But this can work to your advantage if you're selling calls and puts. Fully expecting my premium to evaporate or double my money, I'm now in a position to sell calls and puts. Now, I don't want to lose 100 shares of Tesla, but when you're dealing with Tesla stock, the premium is way too rich. In the off chance that I would have to ship 100 shares of Tesla, I'm pretty sure that I'll have a call option for me to buy back the 100 shares that I just sold from making that premium. It is a dangerous game. and it's not for the faint of heart. Buying the stock is much safer and makes you feel more comfortable. This could get a little bit stressful if you're not ready for it.
Other thing is, I look here, the red line, it never goes any lower. No matter how much the strike or how much Apple share price decreases, you're only going to lose that fixed amount.
That's true. It's very defined risk. The important thing, though, to keep in mind is most options expire worthless.
Yes.
So it is important to realize that
you're kind of giving that up in a lot of instances.
You are giving that up,
and
on average, it is speculation, and I think, unfortunately, some people treat it almost as gambling, and gamblers don't win most of the time. So you do want to use your defined risk, but you need to use it intelligently.
Yeah.
Whenever I place an option, much like the two that I placed yesterday, I go in there thinking that I'm going to lose that money outright. I do look at it like it's gambling. There is no way to predict which way the stock market is going to move, but Tesla moves so violently that there is money to be made.
Let's go through some of the benefits here, because we have leverage, hedging, we talked about defined risk, so maybe you could talk about leverage and hedging a little bit.
Well, sure. Well, the leverage part was in that graph before, because we mentioned that it needed to get past 193.50.
Right.
If you got
right
to 197, well, that option is worth $7, and then you've doubled your money. So there's your leverage. So it's hit or miss to a certain extent, and when you hit, you can hit big. And that, I think, again, tends to be a little too appealing sometimes to people.
Yeah, we saw that in 2021.
Exactly. Hedging, on the other hand, tends to be if you're long a stock and you want to protect yourself on the downside, you may want to purchase a put. There are other ways to generate income, which again you'll get to with writing calls. That's hedging.
That's basically what I do. I buy Tesla stock. I plan to hold it for as long as I possibly can. In the interim, I will purchase puts. Just in case Tesla stock falls, I will make money on the downside, which is kind of awesome because when I make money off puts, I throw it right back into Tesla the stock, buying low, if you will, and I'll sell calls banking on the inflated premium that comes with owning TSLA. I'm totally long on Tesla. I believe it will be a multi-trillion-dollar company by 2030. But in the meantime, Tesla is in open seas, and the waves are rocky as a motherfucker out there.
The whole point of options was really not as a tool for speculation, but as a tool for risk management, to transfer risk and to allow hedging between different parties who wanted to, some wanted to assume risk, some wanted to lay off risk.
Very good. We got less than a minute, so we got to go over a couple of the risks here. Leverage can work for you, can work against you. Also, options are complex, and then time decay. We didn't talk much about that. Maybe you could just address time decay with a little bit of time.
Time decay is...
We're experiencing it now.
Time decay is one of the most unrelenting features of option trading.
THETA. When you're selling calls and puts, THETA is your friend. You want time to expire so that you can collect that premium without having to do nothing. Every time I sell a call for Tesla, I put it so high that there is a snowball's chance in hell for me having to give away 100 shares of Tesla. But if you have 100 shares of Tesla and you want to benefit from THETA, accumulate some premium, here's how I go about it. You want to sell a call. This means you have the obligation to sell 100 shares of Tesla stock should the buyer want to exercise the contract. Now, currently, Tesla is sitting at 185.88. Now, you can have this thing expire any given time. If you're trying to get out of the stock, you could always set the expiration date a little bit closer. Your premium won't be nearly as high as if you set it further out, which is basically what I like to do. If I were selling a call today, I would want to place it for March 15th or so and set it so high, the chance of it being exercised is mighty, mighty low. This is where your tolerance for risk is going to come into play. If I set the expiration date at March 15th at $215, I'll collect a premium of almost $400 up front without having to do anything. When March 15th comes around though, if Tesla stock is above $218.90 per share, there is a probability that I would have to sell 100 shares of Tesla stock at $215 per share. If this is a risk I'm willing to take, I'll go ahead and collect that premium and hope THETA erodes away this contract by March 15th. much like it's done for this 230 call that expires on March 1st.
Well, as I mentioned, the guarantee, I can only guarantee you that there will be no premium on expiration, and that does dissipate as the time goes by. The longer you have for the trade to work out, the higher the premium of the option. As you get closer and closer, that premium declines. The risk, by the way, with trading very short-term options is that premium really decays very quickly. It's not linear. It's an exponential function. Sorry for getting too mathy,
That's all right.
but you fall off a cliff as you get close to expiration.
Yeah. We've been throwing some definitions out here, and we want to talk about everything, but just an opening line to our viewers.
One would be, if you get into options, number one, it requires a certain degree of focus and activity because options expire all the time. And the other would be understand your risk. Before you enter into any position, structure it as defined risk if you're brand new to these markets, but most importantly, understand what that risk is, what it looks like for various outcomes.
Great. Manage your risks, my number one mantra in trading. So let's get to this. Investing in options, these are some decisions and things that you'll have to think about before getting into the trade, including the underlying stock. And I put S in parentheses because you might have multiple stocks involved in the trade, but we can go through the directional bias, the strategy. Just talk to us about some of these things, some of the considerations that investors should have for their portfolio.
Sure. One consideration, you have directional bias. Is this a directional trade? Are you coming in, making a directional decision, buying calls, buying puts outright? Or is this a trade where you're seeking to take advantage of implied volatility being elevated, where you're short vega or short volatility and extracting premium from the market?
All right, we're throwing around a lot of inside baseball terms here, and that's fine because options involves a lot of this, and we want to break it down. So when you're talking about implied volatility, this is the amount of volatility that we're expected, that the options market is saying, we expect the underlying stock to move by this much. And how does that factor into your determination of what to buy an option price at?
You want to understand where implied volatility is relative to itself, and then also realized volatility, which is actually the volatility that's realized looking back over the course of time. Quick example, Microsoft reports after the close today.
Yes.
Options that expire this week are twice the implied volatility that they would normally be. The market expects a fair amount of volatility on earnings, even though it is Microsoft. That's something any option trader needs to understand before they enter a trade.
When you're dealing with the likes of Tesla, you have to understand the implied volatility is going to be constantly high.
Great example, and we're going to get to our next page. Just want to point out that we have to consider expiration dates and strike prices. And let's give an example. Here's Tesla, where we have an options chart, profit and loss, and this is for a Tesla call at the strike price of 210, expiring the monthly expirations on March 15th. So just kind of break down this trade for us.
Sure. Tesla reported last week, unspectacular earnings report. They're overproducing. They've taken down the cost of their cars. Doesn't look great. Stock's down 30% over the last month. You've got people like Cathie Wood, who runs ARK, coming in, buying $150 million worth of Tesla. If you want to express a long directional view in Tesla right here, implied volatility is in the right place for that because it's as low as it's been in 5 years. So it's about 40%. You really won't find it lower. So if you're paying up for premium, whether it be calls or puts, a good time to do it. In this case, we're talking about going out to March, buying the 210 strike call outright for that long directional exposure. Break even's about 11% higher from here. But again, stock down 30% over the last month.
All right, great. And we want to get to another example. This one involves a covered call. This is where an investor sells a call option at a set price and expiration date on a stock that the seller owns in an equivalent amount. So key there is that you already own the stock. And the example we're showing here is NVIDIA, where we have a covered call option at the 700 strike price expiring February 23rd. That's a weekly. Just kind of break down this trade for us.
Sure. Important point here is that the statistical edge in option markets is on the side of the seller, right? So here, You have NVIDIA, they're going to report on the 21st of February. We're using the Feb 23 expiration. We want to sell the 700 strike call. It creates a situation where if the stock happens to be above 700 at expiration, it's going to be a 13% total return over the 3 weeks to that expiration. If the stock is below 700, we just pocket that premium. It's about 1.5%. So in a lot of ways, it's a win-win if you're willing to sell NVIDIA stock up another 13% 3 weeks from now.
The trick is setting the strike price so high, 13, 15, 25%, should that call get exercised. Technically a win-win. On top of premium lost and gained, you have to worry about capital gains tax as well. And it's a zero-sum game. If you've been making a lot of money in options, your capital gains tax is going to be high. But if you've been losing, or if you're in a wash, you obviously won't have to worry about paying taxes. Every time I win, I set aside a quarter of the proceeds for taxes just in case. Should Tesla fall another 10%? My hands will be tied. The question I'll have to ask myself, is it worth spending $7,000 to buy 100 shares of Tesla stock at $170 per share by June 18th of 2026? The implied volatility at the moment is almost 49%. And to break even, Tesla stock would have to be at $241.75 per share by June 18th of 2026. Seems like a pretty good deal to me. In conclusion, a Delaware judge voids Elon Musk's $55 billion pay package, sending TSLA tumbling in the after hours, making me regret having purchased 2 call options yesterday. You win some, you lose some, but you live. You live to fight another day. Speaking of options, thanks to Yahoo Finance, I've given you a little brief introduction of options trading and a little insight to what my thought process is on the subject matter. I'm not a furious options trader, day trading left and right. I'll do some 0-day options on Friday, maybe. But I typically use the options market to hedge my long call of Tesla stock. I'm all in on Tesla, whether it be Tesla stock or the Tesla options. There will be periods, much like the start of 2024, where Tesla stock will come into valleys. But there are going to be moments when Tesla stock peaks. My goal is to try to make money on the way up, as well as on the way down. I'm not saying I'm going to be successful. Oh no. More than likely, I'm going to fall flat on my face. But I never lose any money that I'm not willing to part with. And every time I win, I make sure to set aside money for capital gains tax. If you do decide to dabble in options trading, make sure you're well aware of the risks because there are no guarantees. That's all I've got for you today. Be easy.